Give a kind of a general sense of how you feel about the housing market today.
So our view right now is the housing market in some respects is really in a slow grind. The new construction for single family had been super resilient despite rates having backed up so much. But now we're starting to see a little bit more challenges as it relates to sustaining their sales pace. And there's more incentives are coming into the market. Affordability concerns are being raised more often than we saw earlier this year when the market was still quite strong, despite those rates being so much higher. But the drop off in starts is promising because that would likely lead, in our view, to sometime possibly late 25, early 26 for a real need for more supply in that multifamily shelter category.
Prominent CEOs, leading economists, iconic investors, insights from the experts. The Walker Webcast with Willy Walker. See who's next.
Good afternoon and welcome to another Walker Webcast. It's my great pleasure to have my colleague and friend Ivy Zelman join me today for what is always gets a lot of views. Ivy, you are a big draw as it relates to people who want to hear about the housing market. That's nothing new. It's been the story since you and I first met, and I came to your housing conference years ago. But it's really a joy to have you on today and to dive into some of the data that you and your colleagues at Zelman do such an amazing job pulling together on the housing market. I want to say at the top that I watched a webinar that you and your colleagues did based on a lot of your current research. And I just want to give a quick shout out to Ryan McKeveny, Alan Ratner, Mark Franceschi, Jesse Letterman, and Adam Baumgarten for all of the great work that they do. And I would highly recommend to anyone. Ivy and I hopefully will give you a synopsis of all that. But if you really want the data and you really want the view, sign up for what Zelman puts out in such a fantastic form. And thank you to all those wonderful analysts who are on the Zelman team for all the great work that they do. Let's start here. Having listened to that and seen all the data, I sort of sit there and go, there's got to be a spot in here where opportunity exists. But most of the data coming back says sort of with rates where they are, there's sort of slow growth everywhere. There's slow growth kind of single family. There's slow growth on multifamily. There's inventories building on single. There's too much inventory on multi. Talk for a moment about just kind of your general sentiment right now. I think one of the most concerning things I saw in that whole presentation was one of the slides that compared the housing market back to the mid 80s and the mid 90s. And I was like, how about we get to some of the later parts of those decades rather than sitting in the middle part? But give a kind of a general sense of how you feel about the housing market today.
Well, first, thank you very much. And I appreciate the very generous intro. And yes, all of my analysts are awesome. So if anyone's interested, please sign up with us and you'll get the benefit of all their hard work and intelligence on the housing market. So thanks again. So our view right now is the housing market in some respects is really in a slow grind. And I think that the new construction for single family had been super resilient despite rates having backed up so much. But now we're starting to see a little bit more challenges as it relates to sustaining their sales pace. And there's more incentives are coming into the market. Affordability concerns are being raised more often than we saw earlier this year when the market was still quite strong, despite those rates being so much higher. The existing home market, we're now seeing inventories begin to rise, as you mentioned, which is a good thing for the transaction side of the market because everyone recognizes if you've been looking for a home, how difficult it is to find a home in a good location. We're now seeing the market loosen up a bit, but that likely comes with price deceleration as you have more competition, especially in markets where the new home production is most prevalent. In multifamily, as you know, we've been cautious for quite some time, but it's actually pretty interesting today as we're seeing that significant supply you mentioned that will get completed, but the drop off in starts is promising because that would likely lead, in our view, to sometime possibly late 25, early 26 for a real need for more supply in that multifamily shelter category, especially when you look at the households being formed, are going to be Gen Zs who need more likely multifamily. So, when you think about our ecosystem and we think about all aspects of shelter, while we're seeing challenges in each silo, I think there's also opportunities.
Start a legacy. Start turning dreams into realities. A better world begins with you. Better communities start with us.
Let's start on affordability. Ivy, your team has a really interesting graph that talks about affordability. We're at 20% above trend as it relates to home affordability. And if you go back and look at the slide as it relates to where we were from the great financial crisis to pre-pandemic, we were actually at 75% of average. So we were well below, 25% below average as it relates to the cost of single family housing, just because of where mortgage rates were and being so low. Now we're well above that. It seems like the market's in this kind of push-pull to kind of, if you will, accept or get to a place where that household affordability number gets to something that people feel like is sort of normalized. There was a data point in there that was talking about how sensitive the single family market is to rates, and where when you're at a 6.5 or above mortgage rate on a 30-year fixed, that puts significant downward pressure on overall purchase activity. But when you pick up 10 basis points or 20 basis points and go down to 640 or 630, that really adds a lot to it. Talk for a moment about, if we do get cuts here, can we see a kind of resurgence on the cost of homes coming down and actually the purchase market pick up significantly?
I think significantly might be a stretch, because the question is, why are rates coming down? If it's a sort of a soft landing and job market continues to be resilient, well, albeit not running as hot as it was, but call it, 200,000 jobs or whatever, and wage inflation is still 4 plus 5%. But when I think about, where affordability is today and the sensitivity to rates, it's only in the context that is a very much stable economy, right? So if the economy is weakening and that's why rates are coming down, different story. But today, the lock-in effect, as we all know, with the free money that everyone was accessing during COVID, what we have is today more than roughly 80% of homeowners that actually have a mortgage are locked in below 5. So where the sensitivity is, we get closer to that. And it was over 90%, but with all the originations that we've been doing that are north of 6.5, 7, it's that number's been coming down. But that lock-in effect has really disincentivized people to move. So what would be the right number to get them to move is really what people talk about. And people think roughly 5.5% could be the magic number. One other thing to contemplate, we have an inverted yield curve. And as a result of the inverted yield curve, the spreads that typically we see, the 10-year versus the 30-year mortgage rate, is about 100 basis points wider than normal. So there is optimism that if you took that 100 basis points and you compressed it to normal, mortgage rates would be 5.5 right now. And why they remain wide, if we get a de-inversion, they likely compress. And there's, some optimism that we can get to, we don't even need the Fed to cut. If we get likely Fed cutting will get us a de-inversion, but if that's the right term. I do think, though, where you mentioned affordability, it's incredibly challenging for today's prospective buyers, not only with the monthly payment, with rates rising as much as they have, but home prices having continued to rise north of 5-6%. And even wage growth, although trying to keep up, we have other factors like homeowners insurance, which is soaring, and other incremental costs that are also weighing on consumers' ability to buy. So I think it's tough for people. And one of the things we saw during this higher rate environment is record cash purchases. So there's more challenge, as you'd expect, at the lower end of the price spectrum. And the more fluent higher end is still doing relatively well, but there's a lot of sellers that we call it, they have aspirational pricing. They want the peak pricing from COVID. So there's holdouts, but I do think that there's the spectrum of where the healthiness of the market is the strongest is really at the high end.
So a couple things on that. There's so much in here and so much data to talk about. your team did an analysis of single family rental versus home ownership in a number of MSAs across the country and in the same school district specifically to try and compare SFR to home ownership. And in, I believe it was last year's numbers, the delta across those MSAs was about 9% disparity or difference of the cost of rental versus ownership. Am I right on that?
Actually, you're 100% correct, but it was build for rent. So distinguishing an existing home would not have been included in that analysis. It was a brand new build for rent home.
Okay. And you see that delta expanding or shrinking as it relates to the cost of renting a home versus owning a home, given those adders, if you will, as it relates to insurance cost and mortgage cost on the ownership side? Would that 9% expand out in your thinking or shrink?
I think that it probably expands outward a bit and making it more favorable for the build for rent shelter, only because of the homeowner's insurance and some of the other costs associated, whether utilities, property taxes. A lot of those are seeing continued inflation. But I would also note that, single family rental rates are not going up at the same rate. And home prices in the new construction area have, decelerated, and we're estimating they're only going to increase net of incentives about 2%. So with the exception of the other costs and thinking about build for rent prices are not going to be, lease rates are not going to keep going up, it probably becomes marginally more favorable for build for rent, but I don't think that much more significant just because we're putting a lid on new home price acceleration.
And are you concerned at all as it relates to new supply on the BFR SFR side?
It's not significant enough. I think that there's certain pockets in the country where it's more prevalent. Markets like Atlanta and Phoenix and Charlotte and Dallas, there might be some pockets where it's more competitive and therefore rent rates will probably remain somewhat stable. But I don't see that as a bigger problem. And many people like to look at the comparison from apartment rentals to single family purchases. And just to put that in context, we don't necessarily think that's the best analysis just because it's a bit of apples and oranges. But just to stress the difference in affordability, it's nearly 30% better to rent an apartment today than to purchase a home. So the widening of that will create friction in the single family market, but not as much friction as you'd get from the single family rental market, assuming lease rates come down further.
And one of the slides that jumped out at me, Ivy, as you're talking about differences between rental and home ownership, was you're tracking on rent growth. And it's an amazing slide that shows where the CPI is tracking rent growth. And it's this red line that's way, way up. And then you all track 7 other indicators of rental growth, and they're all dramatically below them. And you see this big lag in where CPI rent growth goes versus where all of the other indicators are. I don't want to dive too much into the rabbit hole as it relates to why CPI is still giving us these sort of false prints on rental. But I thought that data point, I mean, if you took that slide and sent it to Jerome Powell and just sort of said, the data you're pulling out on your rent growth is way off of what we're pulling out of actual market sources, is really quite something.
Yeah. And, it's frustrating to many market participants, given that the measure that they're really focused on is the owner rent equivalent. So OER is really the basis of how they're determining CPI, which is 40% of shelter, as opposed to actual rents. They're sampling households, et cetera, but it's not the same data that we have, which is actual rents, right? So we're looking at not only new move-in rent rates, but blended rent rates that are showing that the deceleration, really overall, rent growth has normalized for the most part, and we don't expect much more pressure. In fact, the spring selling season in the last quarter especially showed that rents were actually stable to moving back up a little bit, which we think might be temporary just because the supply that still needs to be delivered could pressure rents in the back half of 24. But, the CPI is no question very much lagging. And I think Jerome Powell knows that. So I don't know. There's a lot of OER that, people say people don't move a lot. So their rents don't change very often. So you have to take that into consideration when turnover is pretty, modest. But I agree with you. It's pretty startling.
I will say I was at a real estate roundtable dinner 2 weeks ago in DC, and I raised the OER issue with Senator Schumer in front of everybody at the dinner, and basically walked through OER, how it's calculated, why it is a sort of a false data point. And it was a bunch of people walked up to me after dinner and they said, couldn't believe that Schumer had no idea about OEL. I said, don't assume too much on how in the weeds people in Washington are. And that's, obviously that sounds like a slight against Senator Schumer, but bottom line was he was very interested in it and really wanted to talk to the head of the Fed about it. So we sent a letter across to him. Let's keep going here for a moment, though, Ivy, as it relates to rates, because we're kind of around it on the CPI print. Yours and my friend Mark Zandi was on CNBC yesterday morning, and Mark's commentary was just, looks like on Thursday we probably get kind of numbers that are in line with where the Fed would like to go, and therefore they set up in their July meeting for their first cut in September. Mark made it all sound as if like this all is kind of all set up. This will play into it. Plenty of people who sort of say, no, the data isn't going to come in line. But if you were to look forward to Thursday and what you think comes out there and then how that plays in to Fed policy, are you on sort of 2 rate cuts, one September, maybe one November, as it relates to 2024 and then we'll talk about how that plays into the numbers that your team is projected for 25 and 26 as it relates to starts, mortgage rates, everything else?
Well, our red inflation in the CPI, 40% is all we forecast. So we're looking at still north of 5% year over year rent growth in the CPI. So that may not be enough to offset whatever else the components that go into the basket that comprise the CPI. But from what we're seeing is the deceleration is not happening that fast, and we expect it to be a bit sticky. So if Mark's right, it might not likely be from shelter that it's going to show up. But if we do get 2 rate cuts, the question is, will that help to de-invert the curve? And does the long end kind of stay somewhat sticky? And that's where you look at the forward yield curve and what's being priced in. And it does have mortgage rates coming down, but not as much. And I think that was before the employment numbers that came out last week that gave more optimism for a July cut. So I think the forward yield curve will probably see even a bigger reduction in what rates would likely be in 25 and 26 as a result of that, cut coming to fruition. So we don't forecast ourselves, but, it makes sense to us that, rates would be lower on the long end, but not that much lower, because then you think about, where the yield curve is on the long end, it's kind of already pricing in the Fed actions that need to come to fruition to, put us back to a more normalized yield curve.
Yeah, that you're spot on it. And it's one of these things that has sort of confounded me as it relates to people thinking that we're going to get rate cuts and that's going to impact the long bond it kind of in lockstep with short-term rates. And I continue to come back and say it might bring them down a little bit, but the concept that, let's just say hypothetically, they do 25% cuts and we go from a 525 to a 475 Fed funds rate. The concept that you're going to take that out of the 10-year on a kind of a basis to basis point, it just doesn't make sense to me. Yet many people in both the single family as well as in the commercial side have sat there and said, "Oh no, we're going to have this big rally in the long bond." I'm interested. You're sort of, if you will, a little bit more in my camp, which is just that you might see a little bit of a rally on the long bond, but it's not going to go on it'll not even close to a basis point to basis point, much less. I mean, what would be your thought if we get down to a 4.75 Fed funds rate by the end of the year? Do you think the 10-year gets below 4?
It could be around 4. It might test like a 3 3/4 at the, likely the most benefit. But I don't really see, based on, what we're looking at for long-term growth, GDP growth, and where, in fact, the short end winds up with inflation 2-3%. Your curve has to be, to be normalized, you have to have the long end higher than the short end, right? So will we get a temporary pullback in the 10-year yield? Possibly, but I think it's going to stay eventually above 4. And therefore, the real benefit to the housing market would be the compression of that spread that we see, the 30-year fixed mortgage rate that's currently hovering 100 basis points higher than the 10-year yield. And that is, at least the numbers from the mortgage guys that we talk to suggest that should happen if we de-invert the curve. Just that relationship. But at the same time, why is it the compression, or why are their spreads wide? Number one, banks and the Fed aren't buying mortgage-backed securities. So there's less demand, which is one reason we see the spreads are wider. And then risk of prepayment speeds accelerating if rates in fact do come down. So that's another reason why spreads are wider. And third was the risk of default. So maybe default starts to become less of a risk. But those are some of the reasons why spreads are wider than normal. So
And
I'm with you. I do not count on the long end of the curve bailing out, whoever's, at this point counting on it as a way to see their business either, pick up and accelerate or see better activity. I would not count on it.
And am I right that on single family mortgages, average spreads right now are at 260 and the historic average has been about 170? So there's about 90 basis points of tightening that could happen if you got back to sort of a more normalized spread environment?
Yeah, that's about right. I said 100, but yeah, that's about right.
So you talked about the cash purchase market a moment ago, Ivy, and a couple things on that. One, some really interesting data from your team as it relates to the number of homes being sold over $1 million. Talk about that growth of where we were pre-pandemic to a year ago to today as it relates to total inventory being sold at over $1 million purchase price.
No, it's been a rocket ship. I mean, we've seen a tremendous spike in homes purchased that are valued over $1 million. And it makes sense given the fact that we have had so much home price appreciation. I mean, I could tell you a home in Naples, Florida that might have sold for $500,000 is now well north of $1 million. So a lot of homes have doubled in value and even tripled in value in certain, coastal markets. So there's no question that, the inflation at the high end has just surpassed any expectations we would have had. So it's more than doubled, if not in some cases tripled.
And does that make you, I know I'm not going to try and get you to make commentary on specific stocks that you all cover and rate, but the Toll Brothers, who is building to that price point, does that trend? And I think the numbers were that 3% of sales in 2019 were for homes over $1 million. It was 7% last year, and it's 9% year to date in 2024. So just as far as total inventory, there's just been this huge growth in that. Do you think that the market can sustain that type of price appreciation so that a Toll Brothers who's building at that higher price point is going to be selling into a really strong market? Or do you think that in the home builders, they've got to kind of reset and come down to an average purchase price that is below that level?
No, I think Toll, by the way, which is one of our top picks, we're actually hosting Doug Yearley on Wednesday for a fireside chat, but we think they're very well positioned. And while Toll might be the only builder that's really, geared to building $1 million+ homes in terms of their semi-custom homes, think about their market share. It's negligible. And today's buyer wants new. They prefer new. A lot of the stock today in the United States is very dated. The average stock is north of 50 years old, and we're looking at the Northeast and Midwest north of that. So when you have this old dated product versus you want a new home, Toll Brothers offers you that alternative. It is such a small number on a relative basis. I think they have plenty of room to continue to offer and see strong growth in the markets that they're serving.
So you're talking about market share, and one of the interesting data points I saw was that the market share of the public traded home builders has grown dramatically. They continue to gain share versus the private builders. A, why is that? And B, if you can give people a sense of how much their share has grown, is it that they have a pricing advantage on buying raw materials? Is it that they've swooped up and bought all the land and therefore the entitlement process is behind them? What's made it so the publics have gained more market share?
Well, to put some context around it, when I started covering the industry in the early 90s, the market share for the public home builders was south of 10%. And today it's north of 50%. Yeah. So it's been a very strong growth story over time. In fact, when you look at Horton and Lennar alone, they account for 30% of new home sales. So they're head and shoulders above the other public builders. But when you think about why, well, the cost of capital is anywhere from 500 to 1,000 basis points lower for the publics. They have scale advantages, whether it's buying raw materials or they're dealing with bulk deals with respect to land purchases. They're making maybe more favorable terms. Certainly the perspective would be that they have access to capital that the privates don't have. But I think overall it's the scale and the purchasing power has been a big factor for them. Now, a lot of private builders that we interact with are doing exceptionally well. and continue to, have very decent growth despite the public's gaining share. So I think it's a story of, if private builders in a regional market where they are dominant and well known and they have a good reputation, I think they can continue to thrive. But I think that the publics are probably looking to buy that private at some point. And so they've also done it through acquisition. I do think that there's a place for the private builder, but they do have disadvantages, especially when it comes to the access to capital, not just the cost of capital, but accessing capital, and banks when they're pulling back and that's their source, they're at a disadvantage. The scale from purchasing, whether building products, whether it be land, I think those are advantages that the publics will continue to derive, especially because in this market environment, land is the most significant land raw material, and it's getting harder and harder to buy land that you can get entitled and take through the process in a reasonable time frame. In fact, land was the only thing that never came under pressure during COVID. Land prices have not abated and have continued to increase and putting a lot of pressure on the overall industry. Another thing with the Biden administration is regulatory changes, code changes, energy code changes, puts pressure more on the private guys than it does the larger guys on the public side.
Does the cost of land kind of continuing to go up at the rate that it has, Ivy? I would imagine it makes you think back to sort of 2006, 2007, where land pricing went up and you said, hold on a second, this thing comes crashing down if people are paying that much for dirt. Does the dirt market concern you right now, or does it make sense given NIMBYism, regulatory hurdles, entitlement hurdles, all that kind of stuff?
I think the land market is pretty tight. And I think that, it really goes down to the local municipality level. And so, you have markets like in Phoenix, where maybe starts historically peaked in the 50, 60,000, they can't, even if they wanted, build more than 25,000 starts. And that's a function of getting the land to market, getting finished lots, getting approvals from municipalities. So the market is really strained. And it's also having to do with utility hookups, transformers, the water supply. There's a lot of constraints that were not prevalent 30 years ago, and nor were they prevalent during the GFC. So I think it's going to keep land in that sort of more shortage situation, and the builders that have access to it will provide the volume to the product to the market so that they will continue to gain share. So I don't see any correction in land coming at the moment.
2023 new home sales was 666,000. I think your forecast for 24 is 660, so down about 6,000 units year on year. How does that play out going forward? You getting back to sort of 2 to 3% growth on that new home sales number, or is there anything that would make that grow at a greater clip? And as a data point to give people listening in, the peak of the last decade has been, I think, 830 some odd thousand in 2020. So that was sort of the peak on new home sales in 2020, and we've been coming down to this 660, 666 number. What gets it to get up to 700 and 800,000 again?
I think that's where the constraints are going to be the impediment. So it goes back to the idea of how much land can you put into your assembly plant, and wind up, or your manufacturing plant, so you can actually put it down the assembly line. So that's the problem. And that's one of the reasons why, even if you said rates were to fall dramatically, the builders would have a difficult time getting a number of new communities open and not being in a situation where they're selling out of communities, have nothing to replace it with, which is what happened in COVID. If you remember, during COVID, there were, wait lists, and they were basically, not selling certain amount of product because they had nothing to replenish it with. And that fact is still the case. So even if we said mortgage rates are going back to, 4.5%, 5%, and it's the go-go's and everything's great, the builders couldn't supply it. They would just keep inflating the price of the home rather than trying to chase the volume. And right now, the reason why we feel more confident that volumes could increase in the low single digits is because they'll use price as a lever to sell whatever they want, whatever they need to. And therefore, the volume will come at the expense of price if necessary.
And as I hear you talk about the constraints on new supply, if we were having this conversation 4 years ago, I'd be asking you about Katerra and the modular builders and 3D printing and all of that. Is that concept completely out the window, or is there still investments in technology and 3D printing and things that might be able to change the cost of construction and supply side?
There's definitely startups that are attempting to do so, but nothing significant, nothing that has traction enough that we should talk about. I thought about having one of those companies or anyone that's sort of, further along than the first inning to the housing summit that we're hosting in September. And I was chatting with our friend Stuart Miller. He goes, "No, Ivy, there's nothing good enough to bring to the summit. There's nothing that far along." And I think that, one of the industries that we're looking at relaunching on, I used to cover it in the 90s, was the manufactured housing industry. And, when you think about affordability, I think that industry is sort of under the radar and has definitely built factory-built homes similar to what Katerra wanted to do. But I don't think that people have really taken a hard look at those companies, but they're providing what Katerra was attempting to do, but they've been doing so for decades, and it's improved. But if you go to one of their factories, which I have, and even recently, last few years, they have an assembly line, and they're moving through with everything produced in the factory.
Yeah, the problem there, as I've always seen that, and as you well know, we do a lot of financing on the manufactured housing side, on the W&D side. The NIMBYism, as it relates to however you want to call them, most people would go to mobile home parks, is about as significant as nuclear power plants. I mean, it's like people here, you're going to go build a nuclear power plant, and they think 3 Mile Island immediately, even though the technology has come so far, and as Bill Gates has done a lot of work on, that really is the future of clean energy in the world. And we got to get on it. We got to get over this branding, but it's the exact same thing on manufactured housing. Everyone says, "You're going to put a trailer park in my backyard? No way. We're not going to give you zoning on this." And that's been one of the big impediments to entitling land to allow for that housing product to actually grow significantly. And one of the things that stuff has been gold from an ownership standpoint. I mean, when we look at, the number of big institutional investors who would love to buy up those properties, there's just no entry point because the people who own them are just sitting on a gold mine.
Cash cows, yeah.
Yeah.
I visited with Clayton Homes 2 or 3 years ago, and they were telling a story in Knoxville where they're headquartered, where they had product and they've changed the pitch of the roofs, and it's been approved by Fannie to finance it. And they've made a lot of progress that actually you couldn't tell the difference of a manufactured home versus a site-built home. And we were in a cul-de-sac, and they were telling us a story that, the homeowners saw, a mobile home coming down the street, and they went nuts. Yeah. And meanwhile, they had no idea that their neighbor was in one, because it looks exactly the same as a site-built. So there's a lot of work to be done for the industry to overcome those perceptions. But the quality of what I knew in the 90s when I used to go to mobile home parks and visit various sites, it's nothing like it was back in the 90s. So they have work to do on changing perception, but that could help solve the affordability challenges that we have too, assuming we get over the NIMBYism and everything you just spoke of.
You talk about the pricing power, if you will, of the publicly traded home builders. Inventories are building on the single family side of things. And what do they do there? They're going to give up more. They're going to give more concessions. I mean, there's been a lot of buyer financing that some of the big public home builders have been doing. Any of that cause you concern as it relates, or are they doing so well right now from a margin standpoint that they've got a lot of pricing elasticity, if you will, to be able to play around with inventories and make sure that they're selling at the proper margin and being able to continue to develop new homes?
You hit it the nail on the head. Exactly. They're still punching above sort of historical, what we'd call normalized gross margins. So they have some cushion to take on more incentives, whether it be mortgage rate buy downs or whatever they need to do. But the benefits to, turning the inventory and getting it sold to the consumer, tremendous benefits to their returns. And that's where the shift has been in the last several decades, is that, bottom line profit, or now more focus that shareholders have demanded for them to focus on returns. And that's what they've been doing. So for Lennar and Horton, as example, they are pretty much no debt, and they have pretty high returns on capital. So for them, I want to move my inventory. I don't want it sitting on my balance sheet, and I want to drive whatever I need to. And if it means lower gross margins at the expense of higher returns, I'll take that. And that's what the industry has moved towards. And they believe that will ultimately give them a better valuation.
And the starts to orders index doesn't concern you right now? You think it's, in a range where there's a relatively bullish sentiment on the builders, but not overly bullish and not pessimistic as it relates to starts to orders?
Well, inventory's building. The spec count is definitely above where, I think everybody would like it to be. We saw a pretty big drop off in June in starts. And so the question is now, is the market sort of reconciling where we had a lot of spec moving towards consumer wants, the move-in ready home, but wait a minute, things are slower than it should be this time of year. We better take a step back. So I think the market will adjust. I think the builders are smart enough to recognize that if the market is slowed, they're not going to keep speccing at the same level.
And you all did a really interesting analysis as it relates to the savings rate versus single family home appreciation and found that there was quite a significant correlation and a lagging effect, but where the savings rate was versus how much you could push pricing on single family homes. Does the health of the consumer concern you a little bit right now, given that the savings rate has obviously it's plummeted since the pandemic, but that was at a 25% savings rate that we never expect to get again because everyone was getting checks from the government and all that stuff. But it's actually now below trend over a very long period of time, where the trend has been about a 5% savings rate, and we're now about a 3% savings rate. Does that concern you as it relates to single family home appreciation going forward?
Absolutely. And I think that, looking back, at the last few years where, home prices were soaring, even in the last several months in the first half of 24, when the market was more resilient than we would have anticipated, with that savings now depleted, what we've picked up in our June survey, I'm trying to see what month we're in. No, we just did a preliminary June. For the May survey, we indicated that affordability was one. Comments from our private builders that we survey was coming up more frequently, and more credit concerns. And so there's no question that the tie and the correlation to the savings rate being depleted is now showing up in more commentary and concern around the ability for the consumer to not only afford, but might have pushed themselves too far, and therefore might have taken on more than they could chew in some cases.
Let's shift for a moment to multi.
Sure.
You all just brought up your rent growth forecast slightly, not a ton, but you had 1% growth in 24 and 1% growth in 25, and you brought those up to almost 2 for 24 and a little bit over 2 for 25. So a slight improvement, the positive trend.
Right.
What's the view on the oversupply in multi? And I'd actually, while I'm at it, I'll throw a whole bunch at you and you can sort through what you want to answer. There's that great graph that you all put forth of the oversupplied markets and where there's downward pressure on rents, and then the undersupplied markets of the Midwest and the Northeast, where you have lower supply and you're actually able to move rents. And that's a fantastic view, at least my view of it, as it relates to where you've got this kind of oversupply that's putting the downward pressure, and then the undersupply where you've actually got the ability for rent growth. Talk for a moment about the kind of the general outlook as it relates to the inventory that's out there today that's put the pressure down on rents, and then why you all revised rents up for the 24-25 outlook.
Well, I think first on that, the rent inflation or the adjustment that we made, although slight, is really because maybe we took it down too far to begin with, and recognizing that in 24, we have seen more resiliency and stabilization in multifamily rent rates. So I think that while we're a little concerned still that we can see competitive pressures in those really supply-laden markets, we do think that where we are now is closer. It might even still be too conservative. We don't expect much more pressure than we've already seen or we've already experienced in 23. But I think that when you look at the national, footprint, the Midwest and Northeast and areas where, all the fast money that wanted to be in multifamily and all the developers, with all respect to them, they go where the population is growing, right? Where they go to the Southeast, they go to the Southwest, and where you had more affordability as well, and you can build and there you can develop. So there's just a lot more competition in those markets that you are now seeing the pressure as a result on why rent rates aren't going to go higher. And whereas in the Midwest and the Northeast, no one's really doing a lot of development. And therefore you have a lack of supply that can allow for rents to be stable to higher. But I think the mix overall, we're probably in that 2-ish%, feeling pretty comfortable there. And it could be that there's, some markets that are negative. There could be markets that are closer to 4 to 5. I remember talking to multifamily operators that would do cartwheels if they can get a 2 to 4% rent rate. So, we're kind of in that low end of the normal range, we think.
And on completions, one of the things that a lot of people have been looking at is how much inventory came in at the end of 23 and the beginning of 24. You all right now have completions for 24 at about 540,000 and completions for 25 at about 500,000, 500,000. That's quite a lot. Are you feeling, given the absorption that has happened over the last 12 months, you feel pretty good that that type of delivery volume can be absorbed by this market? And then we'll go to the new supply because that drops down significantly where the opportunity sits, as you said previously. But talk for a moment about absorbing 540,000 in 24 and another 500,000 in 25.
I think the market is deep enough that it can absorb it. I think the question is, are the operator developers, are they going to be able to deliver in the cycle time that we expect them to? Because it's been elongated and surprising us on how the lack of completions have come to fruition over the past several years. And then we had a spike in completions and it was absorbing it, and we saw the pressure. So, year to year, the completions that we have had a lot of volatility and have done more to do with just getting everything to the cycle times that have been delayed, supply chain issues, municipalities holding up approvals. There's been so many delays, especially in high rise. So we think it can be absorbed. And we do think that there might be, again, some pressure in those markets that have the most supply that will get delivered, but we think the market will absorb it.
And then if you're thinking about a 24 to 36 month development cycle, right now you all have starts for 24 at about 300,000. So the thinking there is you're going to get a pretty significant step down in the sort of 26, 27 timeframe, given the dramatic drop off in starts, correct?
Right.
Yeah.
And I think that makes us feel more optimistic that there could be a turn coming that would be beneficial to the multifamily developers if those that are looking to, break ground and start more potential, development. It might make sense. And assuming they're going to deliver in 26.
And I think you have 3% rent growth in 26, which is still below the historic average is 3.8, right?
I would say we look at it sort of a range 2 to 4 in that range, but
yeah. So it's getting back to trend, but it's certainly not what a lot of our clients have been used to over the past.
It's not the robust pace that we saw over the course of the last several years before the turn, but those numbers weren't sustainable. No one believed it. I don't think your clients believe that those numbers are sustainable in the high single digit rent growth. So it's certainly, while renting is still more favorable than buying, there's a lot of inflation that we've seen in monthly payment for renters as a percent of their income. So there's only so much you can keep pushing on the gas before, somebody's going to cry Charlie and they can't afford it. More doubling up and roommate situations will start to come to fruition.
And what's your take on that as it relates to the overall sort of macro trend as it relates to household growth? Because you all did a amazing cradle to grave analysis that was talking about, if you will, the slow growth of our population and the need for both more immigration or more population. As we look at immigration policy being kind of front and center, yet nobody really wants to do anything about it. And who knows who gets elected president and what that ends up meaning as it relates to any actual action on the border, legal, illegal immigration. What's your view as it relates to just the overall macro outlook for housing over the next, 5 to 10 years?
Yeah, we actually just updated Cradle to Grave, and
I got to take a look at it.
We're more optimistic. I know you'd like that. We raised our population forecast by 100 basis points, and household growth also accelerating, just with the fact that immigration was definitely a part of that revision higher. Even though immigrants tend to have a very low headship rate, they're not, they don't have a social security number, they're not coming in the country and buying or renting the first point of entry, but eventually that will increase. Headship rates will start to benefit from that. But we also saw from 2020 through 2022, there was greater than what we would have expected young adults leaving home. It was for a while, the numbers were post-GFC, young adults were living at home way longer and way above trend line. And starting really in 20 through 22, which is all the data we have, 3 years data, we saw a significant shift to leaving home. And that's also benefited the growth in households. And we expect that the heavy lifting might already been done, but it pushes the overall household growth numbers higher. And so I think that's a benefit from a macro perspective to the need for more shelter. And I think multifamily will be a bigger beneficiary from that increase in household growth in terms of various asset classes. Multi should be the biggest beneficiary.
Super interesting. So as you look at the overall landscape, Ivy, as we started this conversation, the numbers they're trending well, but trending slowly. And that's fine. And people can play into that. As you look at the landscape and you say, single family, home building, single family sales, multifamily build, multifamily ownership, SFR, BFR, and then we haven't spoken about it, but you also cover the home improvement market, but I don't want to dive into that too deeply. But as you look at the landscape, where are you saying right now there's real opportunity? I go long in that space because either there's no money there or there's actually a lot of money that's missing the overall opportunity.
I've been a big proponent for build for rent. I think that people prefer brand new homes and they want that single family experience. I think that the difficulty is, given the cost of capital, is penciling the returns at that elevated cost. And therefore, we've seen a significant slowdown. So let's assume that, some of the market participants are not as tied to whatever borrowings that they need. I think there's opportunities in that space, and a lot of capital that was allocated is sort of been arrested. So there's an opportunity for, the deeper pocket money to come in and maybe do more communities with build for rent. I still think just generally the rental cash flow machine is very compelling versus merchant building and kind of having to build your factory, after you sell it over and over again. So, recognizing I do think there's benefits to being in multifamily long-term cash flowing annuities as well as in SFR. So I like the rental product if I'm an investor, because I like the idea of getting that cash flow and sort of continuity. But I think as we think about the land costs and the cost of capital, it's tough out there. It's not like we've seen a big pullback in land values, like we said, and we haven't seen a lot of, and the labor costs have continued to move higher. We haven't seen any abatement in labor costs. So it's harder and harder to pencil an attractive return. But it relative to, treasuries, for example, people were like, why would I want to own multifamily given where, the long rates are, or even money market? So as we start to see the shifting in the yield curve, there might be more of an interest. But as a, just strictly fundamentally, I think that, we're going to need more rental stock, and the for sale market will continue to carve its way into the sort of existing market, given the old dated stock. Nobody wants those old homes. And no one has the ability to refurbish them completely. So I think the new home market relative to the existing market wins. But I think that the rental stock will be more attractive as an investor because of that cash flow and the returns that you would get if you get that cost of capital down.
What's your thought is about, you mentioned that when you started covering the single family home builders, they had less than 10% market share on the publics. Now they're over 50%. You think there's a similar runway here for the publicly traded multifamily developers / owner operators that you've gotten on the public home builders? Never thought about it before. I don't know.
Yeah, I don't know. It's
plays into it.
So fragmented, and I think that they're not as acquisitive and looking to acquire as much land. A lot of them aren't necessarily developing. Avalon Bay is a developer. You've got Mid-America, you've got some, but not all. So I don't know that they're that growth mode as much as sustaining and pruning the portfolio and, buying and disposing dispositions of some of the assets that they no longer want. So that's kind of been the more of their strategy, is keeping the portfolio, not necessarily growing at a faster rate, but keeping the right assets in the portfolio. And there's been some acquisitions as we've seen, but I don't know. It's a good question.
Yeah, when I was in Chicago for a conference a couple of weeks ago, and one of the things that was discussed was the fact that now that we've gone through the GFC and through the pandemic, the two commercial real estate asset classes that held up really well through those two were industrial and multi. And that now that that's happened twice, and most people who have been investors for that period of time, they sit there and they say, you know, the normal distribution of institutional investment in commercial real estate back at the envelope used to be sort of 25%, 25%, 25%, 25% across all the asset classes. And now there's clearly an overweighting towards industrial and multi. And that those people who have platforms that can actually go take down sites, build multi, manage multi efficiently are sitting in a really good position with the general macro trends you just talked about, as well as I would say the overallocation of institutional capital to multi and industrial going forward. And, you know, you and I meet with a lot of people who either own office or at one time or another been an investor in office, and you sort of say to yourself, when does that market come back? There'll clearly be people who are going to make great trades and make a lot of money off of office over the next decade. There's no doubt in my mind. But the thought that some core fund is going to come in and say, oh, let's go long office right now, or even retail or hospitality, those are becoming much more kind of niche investments versus industrial and multi. And if you take the macro backdrop, you'd say kind of, you know, go long multi owner operator developers.
Yeah. And I think you just said something when I think about the public builders, you know, the view that, you know, these guys were driving around in a pickup truck and it was a pretty risky business and buying land and, you know, speculating and building homes that they haven't yet sold. There was a lot of negativity perceived by institutional investors in terms of how cyclical that industry was. Whereas in multifamily, the perception by the institution is it's a very sound investment, you know, generates very strong returns, cash flow machine. So when I think about fragmentation, I think it stays fragmented just because there's so much institutional capital that will continue to allocate monies where you don't have to be a part of the public entities. Unlike the publics that didn't have that same demand competing for land and opportunities that, you know, today there's even speculation more from institutions that they're now looking at the for sale market and, you know, maybe, you know, Apollo wants to be a land banker and they're coming at it from a different perspective, but there's still more hesitancy on the single family new construction market as compared to the optimism long-term for multi and what a great business it is.
Yeah, super interesting. Ivy, it's been great. I want to thank Ryan and Alan and Mark and Jesse and Adam again for having supplied me with such great data to be able to ask you good specific questions. I hope they were good specific questions. They were clearly specific questions. Whether they were any good or not, I don't know. But thank you to that team of absolutely fantastic analysts, and thank you for all of your insight. A really great session, and thanks.
It's been a lot of fun. I would say, please join us at our housing summit in September. Willy, you'll be there. We're back in person for the first time since COVID. So we're excited to be in Boston, September 12th and 13th. And if you're interested, just reach out to kim@zelmanassociates.com and join us. Should be a lot of fun. But thank you. Really, this is awesome. And hope we shed some light on what's happening in the housing market for your listeners, viewers.
Thanks, Ivy. Have a great day. Yep. Thank you, everyone, for joining us.